Okay, let's talk about employee benefits. Now, the most well-known employee benefit, if you can call it a benefit, is salaries and wages. And there is a separate IFRS statement that just handles employee benefits. That is IS 19. So we are going to touch on this in this year, and then later on in your studies, in your second or third year, you're going to come back to this IFRS statement, but we're going to do the basic entries that IS 19 propose. So after this study, well, in the study unit, what employee benefits are concerned, you should know the following. You should know what is short-term employee benefits. You should know what is a salary scale. Now, let me quickly tell you what is a salary scale. All the positions available in an entity is on a certain level. So the entry level, the most junior position in a company, can be most probably post level 1. And then maybe if you are the MD of the entity, you are on the highest post level, and that would be post level number 8, for example. Now, if you are actually appointed on level 1 and on the entry level, then it can be that your salary scale can be something between 50,000 and 80,000 Rand per year. If you're on post level 8, your minimum salary according to the scale is probably let's say 1.5 million, and the maximum is 2.5 million. So each and every job is then being classified as a certain post level. And based on that level, so that seniority level of this position that you have, you will be paid a certain salary from 1 to a top salary of X, of a Y amount. Now what happens is that in a perfect world, these salary scales should be adjusted for inflation on an annual basis. In practice, though, it doesn't happen. Last year with COVID, it was just impossible for a lot of entities to increase salaries at all. Here at the varsity, we didn't receive any salary increases last year, and by the looks of it, we won't receive any salary increases this year. I've been here now 6 years, and in that 6 years, I think our maximum increase was something like 4.5%, something ridiculous like that. So, but attached to a certain level, like if you talk about university, you have a junior lecturer, then you have a lecturer, then you have a senior lecturer, then you have an associated professor, and then you have a full professor. Now, each one of those descriptions, that job descriptions that you have a certain minimum and a certain maximum salary attached to that. Then you must also distinguish between deductions and contributions. Now, what is a deduction and what is a contribution? A deduction very often is something that is legally introduced that the entity doesn't have any choice of deducting that from the salary. An instance of that is, for instance, pay as you earn, and that is income tax. So pay as you earn, the Income Tax Act actually prescribes that if your total earnings, taxable earnings for a year, argument's sake, is 200,000 Rand, based on the 200,000 Rand taxable earnings, your total tax for the year, argument's sake, is, let's say, 40,000 Rand. So what you do is you take the tax tables, you work out the total tax payable based on the total revenue that that person is going to earn for the year, and then I take the 40,000 and divide by 12, and every month a certain 1/12 of the total amount that is due for the year must be deducted from this person's salary. So that is a deduction. The entity or the company that you're working for is obliged to do that. They are legally bound to do that, and they have to pay over that tax to the receiver of revenue before the 7th of the next month. So if you received your salary for January, they should have deducted whatever the tax was based on your total estimated taxable earnings, and that amount should have been paid over to the receiver by the 7th of the next month. Now, what is a contribution? A contribution, for instance, is something towards a pension fund. According to your employee contract, you might be forced, it's obligatory, to contribute a certain percentage of your gross salary each and every month to a pension fund. So that you have to do that. The percentage will differ from entity to entity. Also, entity is also not obliged to give a pension fund to the employees, but most of the medium-sized to big-sized companies do have a pension fund, and you don't have a choice, you have to belong to that pension fund. So they are going to recover, let's say, 5% of your gross salary every month, and they're going to pay it over to the pension fund. Now, what happens is that you will get your money back eventually when you are going to retire. So when you reach retirement age, you go on pension, and then on a monthly basis, you will receive some of that money back, which you have contributed to the scheme. So it actually is still your money. You cannot just use it as and when you please to use it. So that is a contribution. Obviously, you must know how to record salaries and wages, deductions and contributions in the general ledger. And I will not require from you to prepare a payslip, but you should know how a payslip works. Good. Now, what employee benefits? What is that? It's all forms of consideration given by an entity in exchange for services rendered by employees. Now, here you have to distinguish between short-term employee benefits and long-term employee benefits. Now, short-term employee benefits are employee benefits that are due to be settled within 12 months after the end of the period in which the employee rendered the service for which he is actually now being remunerated. So salaries and wages, salaries usually you get it on a monthly basis, so that is for the service that you delivered for that past month. Wages is usually for a shorter period, either weekly or bi-weekly, and you are being paid on a weekly basis for the service rendered for the week or for the 2 weeks if it's on a bi-weekly basis. Things like overtime payments, that is being paid as and when you are working overtime. So I've worked 15 hours overtime this month. At the end of the month, when they're going to pay my salary, my overtime payments will be included in the salary. And the same thing for those bonuses, etc., etc. Now, what is an example of a long-term employee benefit? Now, guys, very often when we belong to a pension fund, our employee and conditions of employment contract stipulates that the employer has to contribute, let's say, 5% to the pension fund. And then it will add on, and then the company will also contribute 5% towards the employee's pension fund. So basically what you receive, what is going to be deducted from his salary is only his contribution of 5%. The other contribution from the employer's side, that will come out of the employer's own pocket, but he will pay in his portion of your contribution into your pension fund account. So basically what it means then, when you are going on retirement one day, you are going to receive your pension back as well as the contribution made by the entity. Now that is a long-term benefit. You will only be able to utilize that employer contribution in the longer term. He contributed on your behalf. It didn't come out of your pocket. So on the one side came out of your pocket, the other side came out of the employer's pocket. And you will only be able to utilize that once you have retired. Okay, so according to IAS 19, short-term employee benefits must be recognized as an expense in the period that the services are rendered. Let's say, for example, that our financial year end is 30 November. The company has a policy to pay out a Christmas bonus, but that Christmas bonus is paid on the work that you've performed for the year. The financial year ended on 30 November. They just don't want to pay it out in the November pay run for your salary. They keep the bonus back for just before Christmas because the entity reckons that you need that money to go on holiday or to buy Christmas gifts or whatever the case might be. But the fact is, although the company is going to pay, let's say on the 15th of December, this bonus payment, that bonus actually relates to the work that you've done from the 1st of December of the previous year up to the 30th of November. The 30th of November, that actually is just before the 15th of December when the bonus is paid. So you have rendered the service in the November ending financial year. So that means in that year, ending on 30th of November, you will have to make provision for that bonus payment that is only going to take place on the 15th of December. 15th of December falls into the new financial period, but the service that you've rendered on which you are getting remunerated for is still in the old financial year, ending on the 30th of November, the month of November before the bonus has been paid. Okay, now I've already mentioned that salaries are usually paid on a monthly basis. Wages are being paid on a weekly or bi-weekly basis. Now, these salaries, is expenses in the statement of profit or loss or in my profit or loss account. Now, the question is, what should be recognized as an expense? And guys, what should be recognized as an expense is actually your gross salary. So the salary that you receive according to your contract of employment before any deductions or contributions have been taken off. Now let's talk about deductions. Certain deductions is in terms of legislation, and that is like pay as you earn, which I've already discussed, and another one is UIF. Now, what is UIF? UIF is the Unemployment Insurance Fund. Now, during COVID, you've heard a lot about the Unemployment Insurance Fund. A lot of entities, everybody had to close down their doors during the hard lockdown, and a lot of companies could not afford to pay their employees during this hard lockdown. Even when we came out of the hard lockdown, it took them some time to really get up to speed again, and some of them will never get up to speed again. But during this hard lockdown, and also for a couple of months, in the relaxed lockdown, I can call it, the government has announced that the UIF will pay out a portion of the salaries of these employees that's affected, in the sense that they didn't receive salaries from the employers that they're working for because the employers can't afford or couldn't afford to pay them any salaries. You must have heard about the so-called TERS payments, and that was initially for 4 months and it was then extended further, etc., etc. Now that came out of this fund, this UIF fund, and people received not a full salary but a portion of their salary every month then from the UIF. Also, if a woman is going on maternity leave, now the Act stipulates that every woman has to take 4 months maternity leave. But nowhere in the Act it is obligatory to the entity that she's working for to pay her for that 4 months that she is on maternity leave. So she has to take the 4 months, but it's not to say that she will get paid for those 4 months that she has to take according to law. Now, to cover this lack of income, women who just had babies and who are on maternity leave can claim a certain portion of their salaries from the UIF during this 4-month period that they are on maternity leave. Now, there are also other examples when the UIF will pay out. Let's say the entity has restructured and it has retrenched a lot of its staff members. If you've been retrenched by the entity that you worked for, you can then claim from the UIF for a certain number of months a portion of the salary that you've earned. So that you can claim a certain amount from them, and they reckon that that should be sufficient to see you through until you get a new job, which it is very often not, but at least it's something. Also, the UIF will pay out if let's say that the breadwinners in a family has passed away, both the father and the mother, and there are dependents staying behind. Then the UIF can pay out for a certain number or a period of time, a certain amount to whoever's taking care of the dependents, and then it will also disappear at a certain point of time. So that is the purpose of the UIF fund. When people basically can't earn their monthly salary, the UIF fund in certain circumstances can pay you a certain amount of money. Now, 1% of each and every employee's salary must be contributed to the UIF fund on a monthly basis. Over and above that, all the entities or employers they are also obliged to pay over to the UIF Commissioner 1% of each and every employee's salary on a monthly basis. So the UIF Commissioner receives on each and every person who's earning a salary 2% UIF based on his gross salary every month. 1% is coming from the employee himself, 1% is deducted from his salary, and the other 1% is actually being paid by the entity who he is working for. There is, however, a ceiling on this amount. So this amount is capped. The amount was now increased quite recently to 177,712 Rand per annum. So 1% of that means that 177 Rand and 77 cents is the maximum contribution that will be paid over to the UIF fund, both by the employee and the employer. Now, there can be other deductions as well, and that can be as a result of an agreement between the employee and the employer. A good example is, for instance, pension fund and medical aid funds. So according to the conditions of employment, each and every employer must have such a contract when they are being appointed at a certain entity. Now, according to that contract, they will stipulate, if there is a pension fund, how much is the employee going to contribute to the pension fund, and how much is the employer going to contribute to the pension fund. The employee's portion will be deducted from his salary and obviously paid over in the beginning of the next month to the fund itself. The same thing can apply to the medical aid. Now, medical aid became very old-fashioned, that the entity will contribute towards your medical aid fund. It's too expensive in any case. So what they will do is they will at the utmost administer the medical aid fund contributions that you are making. So they deduct from your salary your contribution, for example, to Discovery Health. The company will deduct your contribution and they will pay it over to Discovery Health on a monthly basis. But the full amount of belonging to Discovery Health will be recovered from your salary. So there are, as far as I know, no entities, and if there are, they are very, very far and few in between, who is actually still contributing to the pension, to the medical aid fund of employees. Where you still find it is with old people in retirement, and when they went on retirement, it was part of the benefits that they would receive, that the company would continue to pay their medical aid fund contributions. But that is a dying breed. That is not going to be in existence in 20 years from now. Good, so what is then deductions and gross salary? Gross salary, we said, is the expense that should appear in the statement of profit or loss. So that is my expense account. So if I look at the conditions of employment contract of each and every employer, you will be appointed at a gross package of 240,000 Rand per annum. So that means that your gross salary is going to be 20,000 Rand per month. So what am I going to post to my salaries account on a monthly basis? 20,000 Rand, the amount before any deductions has been taken off. Now, the amount that's going to appear in your bank account is going to be your net salary. Now, what is net salary? That is my gross salary, less all the deductions that we have to make from your salary. So your pay as you earn, your pension fund, your medical aid, whatever is going to be deducted from your salary, you will only receive the amount after the deductions have been deducted from your gross salary. So your net salary will be paid into your bank account, and the deductions, all the SARS deductions or pension fund deductions, whatever the case might be, that is deducted from your salary. It is a creditor for the entity because the entity has to pay over that money to the fund or to SARS or to whoever you should pay it over to. Okay, now pay as you earn, we said that that is 1/12 of your estimated taxable income for the year. So they make an estimate. Now it's a fairly easy estimate to make if you are employed. You know exactly how much is your salary going to be for the next 12 months. There's a sliding scale, tax sliding scale. You go to the Receipt of Revenues tax tables. On that tax table, you'll see if I earn 240,000 Rand a month, that would be my total tax that I have to pay on the 240,000 for the whole year. So what do I do once I've determined that amount? I divide it by 12, and that is the amount that will be deducted from the monthly salary from this employee. UIF is 1% of the gross monthly salary, and there's the maximum that can be deducted of 177 Rand and 12 cents. Other deductions include skills development levy. Now, that is a levy that's been paid by the employer, but it also appears on your payslip. Now, when we received, or when real democracy actually kicked in South Africa many months ago, it was decided that all industries should be represented by a so-called SETA. So if I have a mining company, I will belong to the mining SETA. If I am a bank, I will belong to the financial services sector, SETA. If I am manufacturing whatever, I will belong to the manufacturing SETA. So there is a SETA for all kinds of industries in South Africa. Now this 1% levy is being paid over to that SETA that the entity belongs to. Now the purpose of the skills development levy initially was to get funds together so that previously disadvantaged people can receive training to do some kind of job so that they can find a job in the marketplace, because as a result of their background, they had a backlog, they didn't have enough education or expertise or whatever. They are trained then, and then they can go and find a proper job in the marketplace. So that was the purpose of the skills development levy. If an entity provides the skills development, now there's all kinds of things that you have to adhere to, but if you are then basically, if you can prove that you actually provide skills development in your own entity, you can claim back from the SETA a portion of the 1%, and maybe in exceptional cases the full 1%. So it is it's something that is a deduction, but it's a deduction for the employer. Medical aid funds, I've spoken about that. It's a deduction. It's administered by the entity. They take the money from your salary, then they pay it over to James, Bonitas, Discovery, whoever you belong to. Pension fund, I've also spoken about that. It's a deduction from your salary. The entity can or cannot also contribute an amount to your pension fund. So what is our expense account? And that is important. Our expense account is the gross salary. So that is the amount before any deductions or contributions. Okay. We get gross salary, then we do the deductions like pay as you earn to SARS, pension fund to the pension fund, medical aid to the medical aid, or whatever other deductions there is. It's being left over the net salary that's been paid over to the employee. Now, in some cases, what is employer's contributions? That is when the employer also contributes to something that you receive any benefits from. And that is typically contributions to the pension fund, if that is the case, if there is a pension fund, and if the entity wants to contribute to the fund, or to the UIF, and they are legally bound to contribute to the UIF. And that amount is also capped at 177.12. So that's the maximum that will be deducted from your salary, and this is the maximum that the employer will contribute to the fund as well. Good. Let's have a look what a payslip looks like. Now, the outlay for payslips might differ, but this is the basic information that appears on each and every payslip. Obviously, what month are they paying your salary for? It's the month of February, March, April, whatever. What is your name, full name and surname? What is your occupation or a position in the entity? This guy's a director. He doesn't do that well for a director, but that is his job description. His ID number will appear there. His employee number, each and every employer has its own unique number that should appear there. And then his tax number, his tax reference number. Now this is obligatory, it cannot be open because according to the Tax Act, each and every person must have a tax number. So each and every person, as soon as you receive some kind of employment, you must be registered as a taxpayer with a receipt of revenue. And guys, that goes for everything. Even simple stuff like students who act as markers or facilitators, whatever, they don't earn a monthly salary. They only receive this little bit of money for the effort of marking or scripts or whatever. The university will not pay them unless they can provide the university with a tax reference number. So if you earn any kind of money from any kind of entity, you must be a registered tax person. Now, obviously, when you only receive a little bit of money, you can claim the tax that was deducted from that money back from the receipt of revenue if you're under a certain threshold. Over a certain threshold, well, you have to pay tax. That is life. Tax is with you from now till you die. Good. On the one side, you will see all your earnings. So in this case, this guy only received a salary, but things like overtime, bonuses, all that kind of things that he has received for the month, each and every one will be set out here. What did he receive money for? And then you will get his total earnings for the month. Then somewhere on the pay slip, your total deductions for the month will appear. Pay as you earn will always be there. That's your tax that was deducted from the salary. Here's your UIF. You can see clearly it's 1%. Your pension fund contributions. So your total deductions from your gross salary will be 1675. So the amount that's going to appear in your bank account is only 3325. Although in your employment contract it states that you receive 5,000 Rand a month, you will see the amount that actually receives as in your bank statement is only 3,325 per month. Now, the employer's contributions to stuff that will benefit you eventually will also appear on the payslip. The UIF contribution of the company is the same as yours. That will appear there. His pension fund contribution, here you can see clearly it's on a Rand by Rand basis. He also contributes 375 Rand to your pension fund. So this has not reduced your 5,000 Rand or has added to your deductions or had an impact on your net pay, but this was also benefits that you have received. Therefore, it has to be accounted for somewhere. Now, gross salaries, 5,000 Rand, that is the company's expense for salary. So that will go to my salary account on a monthly basis. Pay as you earn, that is an amount. It's not an expense for the company because you have paid it. So I'm going to credit the creditors account pay as you earn each month when I'm going to do these journal entries. I'm going to have a creditors account for UIF when I do this journal entries, and I'm going to have a creditors account for the pension fund when I do this entries because the company needs to pay this over to these third parties. However, the company contributions comes out of the pocket of the employer. So therefore, this company contributions will be an expense and a creditor. So I'm going to debit an expense account for UIF, an expense account for pension fund, and the counterlegs will the creditor for UIF and creditors for the pension fund. Also on a payslip somewhere, they will give you accumulated figures. So figures for the year to date, and that year will be the tax year. So this cycle of a payslip is always from the 1st of March of a year up to the 28th or 29th of February of the next year to coincide with the tax year. Let's do quickly an example. Mr. Hill has an annual salary of 120,000. Please note it's an annual salary, so therefore his monthly salary must be 10,000. The pay as you earn rate is 25% of his gross salary. So every month they're going to subtract or deduct from him 25% of 10,000, and that needs to be paid over to receive of revenue. UIF is 1%. He contributed 7.5% of his salary to the pension fund, and the employer contributes 2 rand for every 1 rand that he contributes. So 7.5% of 10,000 give me 750 rand. The employer contributes 2 times that amount, so they will contribute then 1,500 rand. And you have to do the journal entries. Now guys, in order to do the journal entry, it is important that you understand what the salary register looks like. Each and every month, there is something that they call the payroll run in an entity. So after the salaries for the month has been finalized, then they run it through the computer. The computer has got a different module that's going to do all these pays, you earn deductions and salary deductions, etc., etc. And the end result after all that has run through the month, the computer will then give you a salary register. If you're still with Noah in the Ark, then you will do it exactly like this, but just in a manual system. But the information that you're going to get at the end of the day looks exactly the same. The name of all your employees will appear in this register. Next to the name of each employee, you will see the gross salary for each. And then you will see the deductions for each. In this case, pays you earn, UIF, and pension fund deductions and contributions. Then you will have a net salary, and then you will have employer contributions. So if you look at Mr. Hill, we've already established that he receives 10,000 rand per month. That's 120,000 for the year divided by 12, 10,000. Pays you earn was 25% of his gross salary, so that deduction is 2,500 rand per month. UIF is 1% of his gross salary, that equals 100 rand. Pension fund is 7.5% of his gross salary, which equals 750 rand. So his total deductions for the month is 2,500 plus 100 plus 750 rand. So his total deductions is 3,350 rand. When you deduct that now from his 10,000 gross salary, it means that the amount that's going to appear in his bank account is only going to be 6,650. Now, the employer also contributes on a 1-to-1 basis to UIF, so that is also 100, and to a 2-to-1 basis to his pension fund. So here's the employee contribution, 2 times 750 equals 1,500. Now that is what the salary register looks like. Now the next question is, how do I get these figures in my general ledger? So if I have to pause a journal entry to show me what the entries look like, I will debit my salaries account, expense account, profit or loss with 10,000 rand. I will credit a creditor for pays you earn of 2,500. I will credit a creditor for UIF of 100 and a creditor for pension fund of 750. These amounts are being deducted from the employee's salary, but it needs to be paid over to the third party, SARS, UIF Commissioner and the pension fund. So this is just an administration burden that the company carries on behalf of the employees, and they make sure that all these amounts are being deducted, number one, and paid over, number two, to all these relevant parties. The 6,650 rand before it's been paid out to the employee will go to a creditors for salaries account, but then when payment takes place, obviously that account will be debited and bank will be credited. The employer's contributions, now remember this comes out of the pocket of the employer. Therefore, this will be an expense, 1,500 rand, debit account, expense, and I will create my creditors for pension fund because it needs to be paid over to the pension fund as well. And the same thing applies to the UIF. I will have an expense account for UIF and I will have a creditor for UIF. So if we look at the journal entry salaries, expense account profit and loss, with a gross salary of 10,000, and then all my deductions will go to creditors accounts. SARS for pays you earn. Remember, there's a separate SARS account for every type of tax. So you will not group all the SARS accounts together. They don't even, in SARS, group anything together. They don't even know what is happening in another department. So There will be a SARS account for VAT, a SARS account for dividend withholding tax, a SARS account for pay as you earn, and this is the one that you're working for now. It's 2,500. The UIF commissioner, 100 Rand. Which 100 Rand is that now? That is that 100 Rand, and the pension fund will then also be credited with 750 Rand. The net salary will go to creditors for salaries, 6,650 Rand. Then the employer's contributions needs also to be processed. So that we've said will be an expense account and a creditors account, an expense account and a creditors account. So pension fund expense account will be debited with the employer's contribution of 1,500. The pension fund will be credited with 1,500 Rand. UIF expense account will be debited with 100 Rand, and then the UIF commissioner creditors account, statement of financial position, will be credited with 100 Rand. Now I'm going to pay my employees. So once I pay my employees, I will debit my creditors for salaries account, things out of my books, and I will credit back. By the 7th of the next month, I should settle all these creditors, SARS, UIF, pension fund, etc. If I don't settle SARS and UIF, I actually receive penalties and interest. So I have to pay them before the 7th of the next month. So if I'm going to pay them, I'm going to clean out all those accounts. 2,500 Rand will be paid to SARS. How much are we going to pay to the UIF? That 100 and that 100. So we will pay 200 Rand to the UIF commissioner. How much are we going to pay to the pension fund? 750 plus 1,500, so 2,250 Rand. So SARS will be debited with 2,500. The UIF commissioner creditors account will be debited with 200. The pension fund creditors account will be debited with 2250, and bank will be credited with 4950. That, ladies and gentlemen, is everything about employee benefits.